This podcast is brought to you by Reynolds and Reynolds. There are 3 waves of AI transforming our industry. Explore what they are, where AI technology is headed, and what these emerging innovations mean for automotive retailers at rayray.com/AI-waves for more info.
Welcome to Daily Drive for Friday, June 26th, 2026. I'm Jake Neer in Detroit, in for Kellen Walker. Today on the show, the new vehicle market is holding steady at the halfway point of 2026. A new report says the industry's redesign rate has fallen to roughly half of its normal pace, and the window to grab market share is now. And another shareholder revolt in Japan, this time with Honda. Plus, Cox Automotive chief economist Jeremy Robb talks about the state of the market midway through 2026.
We really need to get some resolution, see oil tankers moving, start to refill a lot of the stockpiles that were depleted over time, and then, if we can get gas prices back down for consumers, that will be really impactful for inflation.
Let's run through all the news you need to know to keep up in the auto industry. The U.S. new vehicle market is holding steady heading into the second half of 2026, even with $4 gasoline and ongoing Iran war pressures. Cox Automotive projects a June selling rate of 16.1 million vehicles, with the full year on track around 15.8 million. But the market stability masks a major shakeup in share. Ford and GM are both expected to lose ground, while Toyota, Hyundai Kia, Stellantis, and Honda gain. Cox senior economist Charlie Chesbrough says Toyota could even overtake GM as the top-selling automaker in the U.S. by year's end. We'll hear from Cox chief economist Jeremy Robb in just a little bit, who digs deeper into the state of the market midway through 2026. With those challenges as the backdrop, it's survival of the freshest. That's how analyst John Murphy characterized the state of the industry during his inaugural Murphy Automotive Product Pipeline report. It finds the industry's redesign rate has fallen to just 7.1%, roughly half its normal pace, pushing average vehicle age toward a record high. Speaking at an Automotive Press Association event in Detroit Thursday, Murphy said, quote, "The valley on product introductions has never been deeper."
Between model year 26, 27, and 28, we are seeing sort of a crushing depression. And the only reason model year 27 kicks back up is you have the Silverado and Sierra in it. The reality is the rest of the industry is hurting in a huge way.
Murphy forecasts hybrids will climb from 19% of new vehicle volume today to 27% by 2031, and says automakers refreshing their portfolios now stand to take significant market share from rivals going quiet. And we've been talking about shareholder uprisings in Japan, seems like all week here on the show, and we've got another one to add to the list. Honda CEO Toshihiro Mibe survived a shareholder vote to remove him from the board at Honda's annual meeting in Tokyo Thursday. That's despite leading the automaker to its first annual losses since going public in 1957. His aggressive EV push triggered more than $9 billion in write-offs. Honda has since pivoted to hybrids, targeting 2.5 million hybrid sales by 2030. Proxy advisors ISS and Glass Lewis both recommended reappointing him, and Mibe is predicting a profit rebound. And those are today's headlines. You can find more details on all those stories at autonews.com. On Thursday's show, we talked about the Trump administration's decision to ban Polestar from the U.S. market after this model year. That news sent many dealers scrambling to figure out what was happening and what it meant for them. Our own Urvaksh Karkaria has been talking to some of them and joins me now to describe what he's hearing. Urvaksh, great to hear from you again here on Daily Drive.
Hey, thanks for having me back.
So I assume your day took a turn when this news broke, Urvaksh. What have you been hearing so far from dealers?
Yeah, I mean, there's, as expected, Polestar has 32 stores and maybe a little fewer than 30 dealers and in the U.S., and they've been, as one dealer said, absolutely devastated, shell-shocked. They had no heads up on this decision. There was a call, I believe, at 10 a.m. Eastern yesterday, in which they were informed. No details were shared. They were very light on details. Essentially, they were told that, we're leaving the country because this decision came down where we did not get authorization from the Trump administration, for an exemption to this rule that U.S. automakers cannot have China-tied technology for connected vehicles, both technology and hardware. So the dealers basically are extremely frustrated with Polestar, understandably. They've invested tens of millions of dollars in these stores, in this brand, and then suddenly, Polestar backs up and says, we're out of the market. Until recently, they've been telling dealers, we have a solution, we'll get around this compliance issue, not to worry. And then boom, this just falls out of nowhere on a Thursday morning. Many, obviously, it's too soon, so many of them are scrambling to figure out what they want to do with their stores. One of the dealers I spoke to, incidentally, has his store on the market because he's in the middle of moving to a larger store. And
Oh, no.
His point was like, we needed to move because we're getting an increase in sales, increase in service. And now, hopefully, he hasn't signed a new lease or a new deal on a new space. But, this shows a number of dealers I spoke to basically said, this doesn't sound right because oddly, Volvo has received authorization that gives them an exemption for the same China technology issue. And they're both owned by the same Chinese company, Geely. They both have similar technology in their vehicles, at least in their current vehicles. So the dealers understandably are asking, what happened with Volvo? Why did Volvo get the exemption and why aren't we getting the exemption? And that's a question that, Polestar doesn't have an answer for, or at least isn't willing to reveal. I talked to some folks and Polestar is basically saying that they aren't going to appeal this decision and essentially they're going to be out of the market next year.
And that explanation, this idea that they're not appealing, is sort of leading to an environment where there's more questions than answers, right?
Yeah.
And to fill that gap, there's some conspiracies floating around. Is that right? And not to say that we endorse any of these conspiracy theories, but they exist.
Absolutely. I mean, the dealers I spoke with are like, is this some sort of a face-saving move by Polestar to exit a market in which they really weren't doing well? Only 6% of Polestar's volume is in the U.S. Is this a way to to leave the market and say, okay, this was out of our hands, and maybe it also helps with some negotiations with the dealers. If they left on their own accord, maybe it would be harder to tell the dealers that you're on your own. You've got to figure out what to do with your investments, as opposed to saying, well, the government has banned us, so we're really sorry. And, each dealer is now going to have, one-to-one conversations with the brand to figure out or negotiate some kind of an exit plan to recoup some of their investment. Again, this is not, a group thing. This is a one-on-one case-by-case basis, because some dealers have mall stores, other dealers have more expensive traditional showrooms and service centers. And, it'll be interesting to see if, this is America, it'll be interesting to see if there's a lawsuit.
So if nothing changes and they are blocked from selling Polestars after this model year, what do they do? I mean, do they sell other brands? Do they, what options do they have?
So all Polestar retailers are also Volvo retailers. That was, being a Volvo retailer was a condition of getting the Polestar franchise. So, I mean, I guess as a retailer, they could go and, try to find another brand, another franchise, but that doesn't happen right away. And that's a very expensive process. So in many cases, I think a large number of Polestar stores are really in malls, so they're leased. So, either they get subleased or, they negotiate with the mall owner to essentially get out of their lease. For the ones with the larger stores, they'll probably sell it. They'll probably put it on the market, just like this Polestar dealer has done, where he's putting his property on the market, hoping to find a larger space.
Well, Irvaksh, it seems like this is some uncharted waters that we're wading in right here. So it's going to be really interesting to see how this plays out. I know you'll be all over it. Thanks so much for your reporting on this and for joining us today.
Absolutely. This story is not over, so stay tuned. Thank you.
Coming up, Cox Automotive Chief Economist Jeremy Robb talks about what's really driving the auto market at the halfway point of 2026 and what dealers need to be thinking about for the rest of the year. That's next on Daily Drive.
3 waves of AI are transforming our industry as we know it today. Hear from AJ McGowan, Vice President of Research and Development at Reynolds & Reynolds, on all 3 waves of AI in automotive, where we're heading, and what the latest cutting-edge innovations mean for automotive retailers.
So I want you to picture what it would be like on that same Tuesday morning that we talked about earlier with a full agentic infrastructure in place. Your service manager wouldn't start the day by reading reports. Ray hands them 3 ROs that need attention and tells them why. Your sales manager wouldn't spot check calls. Ray already routed the ones that mattered. The GM doesn't reconstruct yesterday. Ray reconstructed it overnight and gave them a summary. And your controller doesn't have to pull the deal level analysis every Friday. Ray runs it on Thursday and flags anything that's worth a conversation. Decisions can get made earlier in the day with better information by fewer people. And that's what the agentic wave actually feels like in your store. It feels and sounds a little bit like science fiction, but at the end of the day, it's not. It's just a faster Tuesday.
If you're interested in exploring how AI can improve operations at your dealership, visit rey.com/AI-waves. That's rey.com/AI-waves.
Welcome back to Daily Drive. I'm Jake Neer. We've been tracking the state of the auto market all week, resilient sales numbers on the surface, but a fragmenting consumer base underneath, with affordability pressures squeezing lower-income buyers out of the market entirely. Cox Automotive Chief Economist Jeremy Robb spoke with Automotive News Senior Retail Editor Dan Shine at the Cox Midyear Report and digs into all of it, from the Middle East conflict's drag on gasoline prices to credit availability to what USMCA renegotiations could mean for the second half of the year.
I'm Dan Shine, Senior Editor at Automotive News, here at the Cox Automotive Mid-Year Report. I'm with Chief Economist Jeremy Robb. Jeremy, 6 months into 2026, what are the kind of the key takeaways, highlights that you've seen so far?
Yeah, I think one of the things we talked about today, especially related to automotive, is the automotive market is quite resilient in the face of everything that's been thrown at the U.S. economy. We're seeing used car sales on a year-to-date basis are down a little bit, but not a lot. And that's against what was a really strong year last year, especially if you think about last year up into about this time, where we had that tariff-induced demand pulling forward a lot of new car sales. And we're actually starting to see our week-over-week numbers right now be stronger on a year-over-year basis. So a lot of resiliency in the new car market. Some of that may be helped out by the stock market itself, what's going on with like the wealth effect and things like that. The used car market still running at pretty seasonal normal trends. We still see a lot of demand there from an affordability standpoint overall, and just everything that's going on. Prices are up a little bit. There's more EVs in the marketplace. So it's a decent part of the economy when we look at a lot of more broad picture, and especially how inflation and the consumer's been impacted over the last couple of years.
If we had this conversation back in January, were you as optimistic or hopeful as the first 6 months have turned out? Are you surprised that we are where we are now?
I am a little surprised. I think in January I was pretty optimistic, but a lot of that was driven from these bigger tax refunds we were going to see. And through January and February, at Manheim, we measure vehicle values every week. We were seeing significant strength versus where we would normally be in January and February in wholesale vehicle values. And that's held up even now through that period of time. Those tax refunds, I think they were coming into the economy. Consumers were going to use them for a wide variety of reasons. And then we got the Middle East crisis. And then consumers have had to use a lot of their extra money to go and spend on higher gasoline and things like that. But even in the face of that, we've seen resiliency in the auto market from a sales trends. So I would say I am a little bit surprised because of where I thought we were going, and then where the conflict, and we just kept waiting for something like that to impact us.
You know, you also talked a lot about kind of this fragmenting, I guess, a little bit of the market, that there's the high end, wealthier consumer who's nonplussed by any of the cost of anything, for the most part, and they're continuing to buy new vehicles. But there's also, I think, seems more and more people who are just kind of getting out of the new vehicle market completely. How big a concern should, I guess, dealers and manufacturers look into that?
Well, I think in the U.S., it's very true. When you think about an average vehicle price of around $50,000, it's pretty expensive, and it's more even people that can't afford that. I talk to people every day. They're like, I'm not spending $50,000 on a new vehicle. Clearly, there's a lot of high-income consumers that can pay well above that, and a lot of high-end trucks, SUVs, big cars, they may be running closer to $80,000. And that's a pretty robust market. It might be slowing down a little bit right now, but it's still really strong. But are you pricing out a core consumer? I think to a certain extent, at least on the margin. If we think about the margins of consumers and demographic changes and younger people and their sensitivity to pricing and things like that, looking for better value, that, over the next decade or two, if we don't do something to address some of the cost pressures on the new vehicle side, we could be impacting, overall just SAR rates for where we see that going too. On the used side, though, we're clearly seeing more consumers wanting to trade down. And what we're seeing is like higher income consumer groups making up a higher mix of the total population of used vehicles sold, and tells you that's trading down. And then at the lowest end of consumers, and those are the ones that really are impacted the most by higher inflation, higher gas prices, and things like that. It's continued to price them out. So you're not seeing the net effect slow everything down, because you're getting this higher end coming in to the pool, but that lowest income consumer is really struggling to own and operate their own vehicle, not just from the cost of the car, but gas, insurance, all of the things.
Well, I think you kind of said it was affordability, and it's not just the sticker price alone. It's all the other things that go with owning a vehicle.
Absolutely, yeah. Insurance costs have really, and maybe 2 years ago, that was much more front and center, especially on the vehicle side. Those costs have gone up a lot. You think about technology in cars, repairing cars, scrappage rates from insurance companies. Those are higher because it just doesn't make as much sense to try to repair the car with all the sensors in it. That's increased insurance overall. As that happens on a macro scale for consumers, it matters more to your overall, not your monthly payment. We talk a lot about monthly payment, but what matters is monthly, am I spending for insurance? Am I making big repairs on a car? Do I have to go replace the tires? All these things. And that's happening while your cost of rent, shelter, or increasing cost of food has gone up, cost of, energy, electricity. Electricity costs are hitting an all-time high, almost like the last 2 months. Now, too, partially driven by data centers and things like that. That matters in the summer when people are trying to turn on their AC units. So, that's where, when you talk about the economy and the consumer overall, it can get real negative easily. On the auto side, from a cost of the vehicles perspective, it's not mattering quite as much, but the overall cost definitely matters.
The Fed, I think it was last week, kept the rate steady as expected, but also indicated that there is potential rate hikes in the future, which was some kind of surprise to everyone. How big a role do interest rates play in vehicle sales and whether people get into buying a new vehicle or not?
Play a big role. Maybe a little bit of a lesser role than in the past, because we've seen more consumers that are, if they can pay cash for the car, they will. And that may sound crazy to a lot of people at $50,000, but it's true. People do that. But there's still the vast majority of new cars are financed, and used retail cars are also financed overall. So interest rates are very impactful on demand overall. And the last few years, we've seen higher interest rates. We've actually seen the total loan base decline a little bit. So there's actually fewer loans out there than we had a few years ago right now. But if we start to see, if interest rates probably not going to go down, in the future, as the Fed stated and all. But the Fed also said they were hyper and focused on inflation. And I think they were very transparent in that. And I think if they focus on that and they're more able to get inflation under control, then a year or two from now, we might be talking about seeing lower interest rates.
A bright spot you talked about is credit availability, and
Yeah.
and it's how is that again? What would that impact vehicle sales for a dealer out there?
Yeah, our credit availability index we put out every month. It's at about a 3-year high right now. It's up pretty substantially year over year. We've seen more lenders willing to finance negative equity. We've seen those longer terms continue to grow out there too. And one of the things we've been seeing more recently too is a narrowing of the yield spread, which means the cost of borrowing for a lender and then what they're going to charge the consumer. And that's good, when you see that, because that means like the overall cost is the compression is a little bit more. I think what's happening with those lender bases, like we've had a lot of them really worried over the past few years. You think about 2022 and 2023, we were coming off really high vehicle prices. We saw a lot of depreciation in vehicle values in the used vehicle market in 2022 and 2023, correcting from the pandemic. That burns lenders. And so they were more cautious at that point in time. They pulled out. Now we've been seeing more, normal rates of wholesale depreciation, which they can model in a little bit better. And then, they may be thinking about the economy. Unemployment's pretty low. We're at positive US GDP growth, things like that. If they think that's going to be steady, all that factors into their desire to lend to consumers. And if there's more desire to lend out there, then dealers can finance more transactions and make that sale.
What are you looking at for the second half of 2026? What are is it the USMCA? Is it, again, the Middle East and how that all works itself out? More tariffs. What are some of the things that you're looking at that you think might, again, impact dealers as we go back into the second half of 2026?
I think the USMCA stuff will come to the fore more, the next few months, and see how that breaks and plays out and what impacts that has over. It's going to have a longer term impact, when it comes through. The one thing I'm really interested in that's partially related to the Middle East conflict is the midterm elections coming up in November. And I think that could have all sorts of ramifications for the economy, but I think also for the auto industry too, as we think about where the pendulum may swing in terms of the overall Congress, Senate, White House in the next few years and what that means for the automotive industry. But the number one thing is going to be following the Middle East conflict. And it appears like we're moving to see some resolution for some things, which is really important and it's going to matter a lot. But it's really put a lot of uncertainty in the marketplace overall, and that uncertainty drives a premium into insurance rates and things like that. And, we hear there's progress being made, but we want to believe, but everyone's caveating that a little bit too. So we really need to get some resolution, see oil tankers moving, start to refill a lot of the stockpiles that were depleted over time. And then, if we can get gas prices back down for consumers, that will be really impactful for inflation.
Finally, what's the key takeaways for dealers? What do dealers need to be thinking about for the rest of this year?
Yeah, I think, there's good consumer demand out there. We can see that going on. You need to be sure whether you're a new car dealer or a used car dealer, consumers have more data than they've ever had, right? And trying to mask that between consumers, I don't think is the way to go, right? Just be upfront, be transparent. I think that's the biggest thing you could do to get the transaction moving because of all the data that everybody has out there. And I think consumers want cars. They want to change out their car. A lot of, even in the used marketplace, we've probably seen a lot of consumers that have hesitated over the past 5 or 6 years that are ready to move and not pay this big repair bill on a 10-year-old car.
Right. There's been a lot of people on the sidelines for the last few years.
Yeah. And as we move through the end of this year and into next year, we're going to continue to see that number one supply chain into the used marketplace, those off-lease maturities, they're going to grow. They may grow. They're going to be more tilted towards EVs than other types of products, but all the products are going to grow out there too. So I do think there's going to be a little bit more supply input. Dealers need to be willing, if they know those are products they can sell quickly in their consumer base, wherever they are, if they're focused on those, they need to be ready to get that car and maybe be a little bit more aggressive on it, because it'll be a competitive market.
Yeah. Jeremy, really appreciate your time.
Absolutely. Nice to be here.
Cox Automotive Chief Economist Jeremy Robb spoke with our own Dan Shine. That's Daily Drive for today. I'm Jake Neer, in for Kellen Walker. Thanks to our own Irvaksh Karkaria, Larry Velaquette, Hans Greimel, Naoto Akamura, and Michael Martinez for their reporting for today's podcast. You can get the latest news on the mid-year auto market outlook, Polestar's U.S. ban, and everything happening in the auto industry at autonews.com. Come back over the weekend for our Weekend Drive edition of the show. Our panel of automotive news journalists breaks down the biggest stories from the past week, including, of course, Polestar's upcoming ban in the U.S.
We certainly had franchises and brands pull out of the U.S. before. We've never had one thrown out that I can remember.
We would really love to hear from you, so let us know what you think of the show and the topics we covered today. You can send us an email at dailydrive@autonews.com or leave us a voicemail at 313-444-2774. And if you enjoyed the podcast, remember to like, leave a review, and subscribe so you never miss an episode.